Hello, all of you. Today we are going to start our new ratio, that is activity ratios. And prior to this, we have covered two more ratios, and they were liquidity ratios and solvency ratios. So, in the continuation, we are going to start the third ratio, that is activity ratios, and it will be followed by one more ratio, that's the last one, that is the profitability ratios. So now let's start with the activity ratios. So activity ratios, they're also termed as performance or turnover ratio. And they are termed as performance ratio because these activity ratios, they measure how well the resources have been used by the enterprise, or in the other word, these ratio measures the effectiveness with which the enterprise uses its available resources, that is men, money, machine and material. Because when the organization they uses their resources effectively, it helps in bringing down the cost of production, which in turn increases the profitability of the enterprise. And the result of all the activity ratios, it will be expressed in number of times, and all the activity ratios they will be calculated on the basis of cost of revenue from operation, which is also known as cost of goods sold. And in absence of information of cost of revenue from operation, we will be using the information of revenue from operation, that is net sales. That means in all the formula, first of all, the priority will be given to cost of revenue from operation. And in case cost of revenue from operation is not given, or it is not possible to calculate cost of revenue from operation, so in place of cost of revenue from operation, we will be using revenue from operation or net sales. And higher the turnover ratio means better use of capital or resources, which in turn means better profitability ratio. So as far as the activity ratios are concerned, they are classified into four types. First is inventory turnover ratio, second is trade receivable turnover ratio, third one is trade payable turnover ratio, and fourth one is working capital turnover ratio. So now let's start with the inventory turnover ratio. So inventory turnover ratio, it establishes the relationship between cost of revenue from operation and average inventory. That means in simple word, inventory turnover ratio is equal to cost of revenue from operation divided by average inventory. And again I want to mention is that in case cost of revenue from operation is not mentioned in the question, so in place of cost of revenue from operation, we can use revenue from operation or sales. That means your formula will be revenue from operation divided by average inventory, in case the information of cost of revenue from operation is not mentioned in the question. An inventory turnover ratio, it aims to determine the efficiency with which inventory is used. Okay, the efficiency with which inventories, how the inventories are used, or how inventories are converted into sales. So formula is of inventory turnover ratio is cost of revenue from operation divided by average inventory. So we'll be getting in the form of number of times. So that means this ratio simply is telling that how many times the inventories are converted in the form of sales. Okay, because cost of revenue for operation means that is the total cost of goods sold, and average inventory, suppose the inventory turnover ratio is 10 times, that means throughout the year 10 times we are able to sold our inventory. That conclusion we are getting from here. Okay. And how to calculate the cost of revenue from operation? It is simply revenue from operation minus profit. That means if you deduct profit from sales, because revenue from ऑपरेशन इट रिप्रेजेंट सेल्स, तो अगर आप सेल्स से प्रॉफिट को हटा दोगे तो क्या बचेगा? कॉस्ट बचेगा. ओके. और इन द अदर वर्ड वी कैन से दैट हाउ टू कैलकुलेट ग्रॉस प्रॉफिट. ग्रॉस प्रॉफिट कैसे निकल के आता है? इट इज सिंपली सेलिंग प्राइस माइनस कॉस्ट प्राइस और revenue from operations minus cost of revenue from operation. So if we deduct revenue from operation minus GP, it will be, you will be getting cost of revenue from operation, and in case it is a loss, then cost of revenue from operation will be revenue from operation plus gross loss. And one more formula is there to calculate cost of revenue from operation that you have learned in class 11th also, that is opening inventory or opening stock plus net purchases. Net purchase means purchases minus purchases return plus direct expenses minus closing inventory. And what are the examples for direct expenses? Whatever expenses you should write in the trading account: wages, coal, gas, fuel, carriage inward, all are the examples of direct expenses. So cost of revenue from operation or COGS is equal to opening inventory plus net purchases plus direct expenses minus closing inventory. And how to calculate average inventory? Average inventory is simply opening inventory plus closing inventory divided by 2. And in case opening inventory or closing inventory is not given, maybe any one is given, one is given only, in that case that will be concerned as, that will be known as average inventory. Okay. In case opening inventory is given or closing inventory is given, either of one, so whatever is given, that will be considered as your average inventory, and that will be directly we will put in the formula, and we will be getting our answers in the form of number of times.